Hi, Piyush. How you doing?
Good, Julian. How are you?
I'm good. Good to see you today, Friday, October 3rd, 2025. Ready for a new market update and interest rate forecast, as well as sharing some insights about what to be expected on the real estate market here in Greater Vancouver. So let's get going. Without any further ado, I will take the lead and present you with the usual charts, supply, demand, price evolution, and then I'll hand it to you. All right.
Sounds
Very good. Let's go. Okay. So right now, let's look at the supply. Let's look at the supply. That's what we're dealing with. So supply is still growing significantly from last month. Interestingly enough, I find it interesting that more people want to sell. More people want to sell. I would have anticipated that some people would hold on their real estate project as per selling their property, given the state of the market, with inventory being flooded and not many sales happening. But yet, charts are showing that more people want to sell. And when I talk to marketing companies that do look after the photo, as well as floor plans, video tour, and stuff like that, they say that they are very busy and people want to sell. So right now, looking at these charts, we are coming back at similar levels than March 2015. So that's what's in for the supply. Then for the sale side, we're still on the very low spectrum. Still on the very low spectrum of the chart. There is a bit more activity that I can witness myself with people wanting to buy. It feels like catching a falling knife, and that's what's going on usually after working for some time in residential real estate markets over the years. When the market is not showing sign of excitement, buyers feel like they don't want to catch a falling knife. They're going to hurt themselves. So that they wait until the market gets better, and then when it bursts, well, then prices go up, sales go up. It's a very difficult window to judge, and timing the market is something I don't involve in, right? I think buying or selling real estate depends of greater events that will dictate your behavior as a consumer on why you're buying or why you're selling, as opposed to timing the market, right? And on that matter, I'd like to ultimately go back to when the market was full swing, 2021. It was very interesting at the time, and Piyush, please stop me if I'm wrong, but when the market was blowing up, we all thought like, okay, that's it, it's going to keep going, but then we were forced to realize that no, he didn't keep on going. And I do have a special chart for us today, which is this one, which basically is showing the percent change from peak. Like when we talk about stats, sometimes a real estate board, which I find very interesting. I don't know why. And they
Can you zoom in a bit?
Sorry?
Can you zoom into the chart a bit more, please?
Yes, sir.
There you go.
So, like the real estate board, when they publish their market stat, they talk about month over month for real estate. Like, and I'm in my mind, I'm like, why do you bother? Why do you bother talking about last month? Like, it's going to be so different. Really, for me, the one that resonates is the year over year, right? Because we always have that 1 year compounding. Okay, so if you look at your bank saving account, what's the interest rate? That's your lighthouse in the night, so whatever that rate is going to go for a year. Okay, so when you look at return on investment, it's going to be for a year. When you look at all kinds of stuff, it's going to be for a year. So the year over year is really what we look at in terms of performance. But this particular chart,
what I would do is like what I used to do when I used to create financials, and certain clients wanted it. They wanted year to date, and they wanted comparison of that similar period of last year. So year to date last year around this period. So that's how you gauge your performance in terms of like, are you still hitting the same benchmarks as you were hitting last year around the same period? And then that gives you a better idea.
Very good point. Like year to date is also a very good time frame to look at, depending on the activity industry you're into. For instance, if you are in stocks trading and stuff, like you want to look at your performance from the beginning of the year and kind of match it from the previous years to see how you're doing. Okay.
Exactly.
But this chart right here is very interesting. Why? Because it looks at price evolution from the peak. So it doesn't take into consideration a time. Okay. So for instance, the peak for most markets in Canada was in 2021. Actually, it was February 2022 here in Vancouver. But all markets was around that date. So basically, this chart is showing the price performance from the peak to August 2025. And here in Vancouver, like we like to be very self-centered and look at our market and be, oh my, prices are declining. And indeed, right? Like if we look at Greater Vancouver, from peak to August 2025, it went down by 8.9%.
Mm-hmm.
But we are number 1, 2, 3, 4, 5, 6, 7. We are in the top 10 performer of markets in Canada. And when you look at what's behind us, there is a lot of red. There is a lot of red. And I was kind of shocked to see that some market lost up to 30% from the peak.
Mm-hmm.
It's quite significant for residential real estate. Significant. And so here in Greater Vancouver, we're holding pretty well, which is a good sign, if you ask me.
And then looking at your chart, and Toronto losing 18%, that's a bit outlier. Without what I was going to say, well, all the other regions, what you see these are like outer regions. So like over here for comparison, we have the Fraser Valley in the Lower Mainland. This is a very indicative of when people like over here during COVID, move to Chilliwack. Why? Because people wanted the space.
Mm-hmm.
They wanted the open air. Like when we were here in the COVID era, everything's locked down. If you're living in a condo, you're masked up, you're gloved up, you're moving between your condo and the parking garage. And a lot of people who could, and then especially the folks who are working from home, right? That would probably drive them nuts. So if I know of many clients,
the necessities for primary residents at the time really changed dramatically.
Right?
Pre-COVID, people were like, it would be nice to have a little corner office, Then COVID, and after COVID, even today, like people are like, okay, I need an office.
So that's what I
corner somewhere, somehow. And then there is the outdoor space, right, which also gained a lot in interest and value since COVID. So those two definitely were driving force in the decision-making process. And that's why those regions, gain a lot in value. But we are forced to acknowledge and witness that period is over. And now people are not so much looking into those areas, and they have other interests and criteria when purchasing a real estate. So we find ourselves with numbers ultimately going, for the most part, between 10 and minus 10 to 30% from the peak, which again is quite significant for a residential market.
Because the whole work from, you're no longer allowed to work from home. So, people now have to commute to work. So now the further you are away from the main city center, the longer your drive is. So it's not as viable anymore.
Yeah, and they have some hybrid solution for the most part. Like they go to the office 2 times a week. They still need that home office. They don't want to commute as much, and so on. So the landscape really changed since then, and we need to adapt. So I thought it was interesting to provide that charts kind of stating the state of the market in different regions all over Canada and the price evolution since the peak, which again, it's a lot of red. Ultimately, for our viewers, that means times are challenging. And going back to the usual charts of our market update, where I will present you with medium sales price. Yeah, so here the market is holding up pretty well, given that it's the most expensive market in Canada. You could have thought that prices would have corrected significantly, such like in similar fashion than other places around. But in fact, it's holding up pretty well. So that shows the resilience of our market. However, my main message for this market update is that, and I see it, and that's why I want to share it with our viewers, is that I see some sellers that bought maybe 2020, 2021, 2022, and they lose money, right? Mm-hmm. They lose money on their sale. And some real estate buyers, sellers, investors should not live with the belief that when you buy real estate, the prices will go up all the time. We are forced to be brought to the evidence that it's not the case. And seller should not expect prices to go up in the month to come. We still have a lot of inventory, and prices will not go up until that inventory is there, and then the demand is still as low. Okay, so sometimes I hear, oh yeah, I bought my property for X much, so I want to make money and sell it for this much. The price of your sales has nothing to do with how much you bought the property for. It's the cold hard truth, but it's the truth. It's the real estate market, and it takes a buyer and a seller, right? And if there is a seller that is more motivated than you, then that buyer is going to go to that seller. That's as simple as that. So numbers you have and you hope for. And in the past, sellers in Vancouver has been pretty well treated by having a very decent return on investment.
Yeah.
That dynamic is not verified in the current market situation, and sellers should not expect to make 5, 10, 15% from the time they bought it out a couple of years ago, 5 years ago. It's not what's going on right now. So if if some sellers are selling, it shouldn't be driven by making money depending on when they bought for, how much they bought it for. It should be driven by more important factors. So
and you can look at other things that's happening in the marketplace where you have developers. A lot of developers themselves are not, their projects not being viable. There's one big project that got canceled by a very well-known developer in the Lower Mainland.
Yeah,
And
was Group Adera. I was at the launch.
yeah. See, and it was sold and it was marketed as a waterfront
It was
property.
a great project. Waterfront, river district, beautiful amenities, nice floor plan, lots of natural light, very good location.
It's a beautiful neighborhood. I used to live there.
Like very good price point.
Yeah.
And still they didn't go for it. I think the most shocking event was the developer that got his primary residence sold on a quarter sale.
I didn't know that.
Yeah. So there is a developer got his property sold. Beautiful mansion. Sold for can't recall how many millions, but yeah, no, like it's.
To be clear, this is another developer, not the West Group guy.
No, not West Group. But yeah, those developers, they take risk when they buy land to then develop, have a building permit in place. It takes a lot of time, a lot of challenges. Time is money, and then they need to get it built. Labor is expensive. Materials are even more expensive. And then the price at which those units come out cannot compete with the resale market or the existing inventory in the pre-sale market. So they prefer to pull out the plug. And it's happening a lot in Toronto. It's happening here in Vancouver as well. So for the time being, the risk is too big. So that inventory has to come down. And again, I'd like to remind our viewer that the stats that we're looking at are about the resale market. Okay, so anything in the pre-sale new build market is not displaying there, and there is also a lot of inventory in those markets.
Mm-hmm.
So right now it's definitely a buyer's market, and some buyers making some moves and getting some great deals in the resale and the pre-sale. If you want any insights, get in touch. So what do you say, Piyush, to sellers that thinks that because the interest rate went down, that the prices of real estate is going to go up?
I would show them your chart, saying how the inventory level have gone up and you have more competition in the marketplace. And I would also show them your second chart where the buyers have not come back in droves as you expected them to be.
Yeah.
But there are some buyers out there, the bargain hunters that are out there, they're shopping, and they get paid to wait, right? So that they have the luxury of looking at 10 different properties. They can put in several different offers and see whoever gives them the best deal, and that's where they move, right? So they're looking for motivated sellers. So it all depends on your situation. If you're the seller, do you want to sell now and then get into something else in the market? Like, what's your motivation behind selling?
Mm-hmm. I was actually involved in a situation where there was two similar units for sale in a building, and both sellers showed extensive motivation to sell, and particularly one of the two, to the extent that the second one was like, okay, well, does it make sense for me to sell at this price point anymore? So it reminded me of the multiple offer situation where like multiple buyers bid on the same property and then seller sells for the highest bid. But this time around it was the opposite, and I thought to myself, like, okay, who would have thought a couple of years ago that seller would have to bid their property down
Mhm.
to find a buyer.
Yep.
So times are very volatile.
They are.
So what's up on the interest rate industry, lending industry, Piyush?
So on the mortgage side of things, everything is steady. You know, we had a Bank of Canada meeting last month after we filmed our last month Zoom meeting. The Bank of Canada decided to drop the prime rate by 0.25. So the prime rate now sits at 4.7%. So that was the expected good news for folks who have the variable market rate.
Mm-hmm.
Bond yields have been coming down. So as you see now, they're at 2.6. A couple months ago, they were setting up at 3%.
Mm-hmm.
So that's when we had seen the fixed rate rise, but fixed rate is steady on the decline. So that's another good thing. One of the key factors is the 10-year US bond yield. We've seen the US government go into a shutdown. Because of that, there may be some volatility on the bond markets. As of right now, I haven't looked into the direct implication of it yet, as I think it's only been 24 hours.
Side comment of it, to me, it's very intense. Like I look at the number one economy in the world, and the fact that they cannot come to an agreement when it comes to the budget, and it forces public jobs to ultimately not be paid anymore, and the country to not operate as it should. And even more worrisome is that this is a pattern. This is a pattern.
Yeah.
And in my opinion, but who am I? It's quite dicey. It's quite dicey.
And it's not good for the future outlook of the United States. This is beyond what we talk about, but they are the prominent economy in the world. All the big stock exchanges, they are over there. Anything happens in those stock markets, it reverberates all around the world. We saw that in the 2008, 2009 financial crisis. We saw what happened there, how it affected all the countries that are, Canada was insulated, even though we're their neighbor next door, but it's not like we didn't get affected. Europe was affected, Asia was affected. So their inefficiencies and the way that they operate has a huge impact. And these things are now happening quite often. It's not like once in a blue moon kind of a situation. Black swan events. Investors are going to start moving away from the United States eventually, right? So how does that affect Canada in the long term? Right? Obviously, it's not going to be good because our economy is tied to the United States economy. I can't remember the stats, but I think, let's say I don't know the number, but at least 50% of our economy has to be dependent because we're a trading nation. We sell goods, we buy goods from the United States. At least 50% has to be going down there.
Yeah, most definitely.
Yeah,
and that dynamic really changed since the tariff announcement. Only by number of Canadians traveling down south for leisure, or also for they had a life down south. Snowbirds going to Arizona, going to Florida. They were like, all right, you don't want us? I'm not coming. I'm selling my place. And a lot of communities in the US are suffering because they don't get those people to come and spend money in restaurants, in activities, and so on. So
and they have
something broke.
And their tourists, the number of tourists that go to the United States, that's also going to go down because they started this new fee, a visa integrity fee, I believe it's called, and it costs you. So, like, if you're a Canadian citizen, you don't get charged, but if you're a permanent resident or if you're a visitor to the United States, you're charged $250 per person for the visa integrity fee. So now, if you're a family of 4, you're traveling from wherever, from Europe, let's say that. However much plane tickets are not cheap anymore. Let's say it's $1,000 per person plane tickets. That's $4,000. Now you've had to add $1,000 on top of that as a visa integrity fee, and then whatever your cost of a hotel and your food for your stay. How many people are going to shell out an extra $1,000 that could have gone towards meals and accommodations, or they could have spent that doing other activities?
And I just want to say, our viewers, we're not planning our holidays. We're just saying that those type of structural changes impact the economical activity overall and the labor force activity.
Yeah.
And to what extent people are going to keep the job, and the evolution of unemployment and salaries, and how is that impact real estate, right?
Yeah.
So the outlook, since COVID, to be clear, right? Like, I used to be a very outlook kind of guy, like, okay, this is here right now, and this is going to go there. Since COVID, that was my lesson. I was like, what can you, we don't know. We really don't know. And I came to terms with that. We just don't know. I do not know what's tomorrow's going to happen. Is there going to be like a beautiful event, Black Swan event? I don't know. But, relying on what's happening right now, well, right now, more and more people want to sell, and less people are buying.
Yeah.
And prices are on a downward dynamic.
They are. And so, in terms of the interest rates, so we talk about the external factors and the internal factors. So the internal factors, depending on the job market, how things are doing over there. Are we creating more jobs? Are we losing more jobs? How's the inflation doing? Inflation rates, are they holding? Are they going down? Because the Bank of Canada is a inflation-driven bank. So the policies that they make in terms of increasing the prime rate or decreasing the prime rate, it is to control the rate of inflation. They want to keep it between 2 to 3%. So right now, we are holding on the inflation side of things, but the government of Canada has other plans. I think they want to change the way the real estate market operates. So they have there's an arm of the government. It's called, for short term, it's called OSFI, or the longer term, the longer name for it is the Office of the Superintendent of Financial Institutions. They're the ones that set the guidelines on how banks underwrite the loans, how we as consumers, when we want to purchase a property, how do we qualify for the mortgage? So they're the ones that came out with the stress test back in 2018.
Yes, sir.
Right. So that significantly, changed, and that was in reaction to what had happened.
Yeah, and I actually can show you the impact of the stress test. It was here. So here, 2019.
That did.
So stress test basically double the interest rate overnight, because you had to qualify for a higher rate than the one you would pay. Yeah. But at the end of the day, you I think at the time, borrowers lost 20% of their borrowing power.
So that's correct. So roughly around $100,000.
Then you can only access 400.
Yeah.
1,800,000. So then we saw that compression in prices, and then it went back up, right? So as per I was saying earlier, like we see those corrections in price evolution, okay, where prices they go down, pricing, and then there are phases where they go up, all right, and we did go through that, and then here that was 2022, then 2023, and then you went back up again, and now we're going back down. It's gonna back up again at some point, but right now we're on a downward dynamic.
So for the folks who may not be aware of what the stress test is, the way it works is that you have to qualify on so whatever your contract rate is. So let's say you get your mortgage rate is 4.2%. You have to not qualify on 4.2% plus 2, so that's 6.2, or the stress test rate of 5.2, whichever is higher. So in this situation, you would be qualifying at 6.2%. So
to be clear with our viewers, there is a reason behind that, and I didn't know the name of the organism behind this. Can you repeat it, please?
Office of the Superintendent of Financial Institution. Short form is OSFI.
Exactly. Long story short, the reason why they did that is because they didn't want Canada to be in the same situation as the US back in 2008. They wanted to make sure that if a borrower steps into a real estate project, buys a residence, primary residence investment property, to the extent that the interest rate would go up, they can afford to pay. That's exactly
so similar to what we saw in 2023, where a lot of folks before that were looking variable because variable rate was lower than the fixed rate. Mm-hmm. And when post COVID, we had a high inflation a period of high inflation. So the bank all around the world, federal banks central banks made a decision of increasing the rates. So we saw people whose mortgages were 1.15%, and with the variable rate, with the prime rate rising and they were being variable, they ended up with their interest rate being 6%. So because of the stress test being implemented, those folks were actually insulated. They were in the realm where they knew they would not get into trouble. So Canada, we did not have as near any number of foreclosures that many other countries experience. So this is folks who are defaulting on their mortgages, and people going bankrupt because of the fact their now payments have gone up. So that stress test, did come in handy. It protected Canadian consumers, and it protected the Canadian banks, and obviously the Canadian economy. So it did its job.
Definitely. And now we see the rate go down, and some of the thinking that I have I'm exposed to is sellers say, okay, interest is going to go down, market is going to blow up, prices are going to blow up. Hold on.
Because OSFI has other plans for you.
Sorry?
Because OSFI has other plans for you. And,
okay.
And I think they anticipate this. And so that's why they had come out with a new guidance. And this is something that's going to be affecting your small mom and pop investors. And this will be going into effect.
Do you have some update from OSFI?
Yes. So
please.
So this has specifically to do with income producing properties. So going into effect January 2026, you are no longer going to be able to essentially double dip on qualifying based on your income. To clarify, so if you currently own a primary residence, and obviously you've qualified for that mortgage based on your salary that you earn right now.
Okay.
So as of right now, then what you do, if you want to purchase another property, you go apply for the application again, and in that application you put your personal income, and you put the potential for the rental income that's going to come from that said new property.
Okay.
Starting January 2026, you will no longer be able to use your personal income on the qualification for the rental property anymore. You now only will be able to use that particular rental property's potential rental income.
Okay.
That's it.
So what you're saying is from January 2026, in order to invest in a income producing investment property, it will all default to commercial mortgage, essentially.
Essentially. So you beat me there. So that's essentially what they're going to be doing. Because as of right now, that rule existed only for commercial mortgages. That's where you're using that, so debt servicing criteria over there, rather than what we use right now for residential mortgages. Residential mortgages is based on gross two ratios: gross debt servicing and total debt servicing. So that's where you could use your personal income to reduce those debts. You're no longer able to do that. So this ruling, it affects your smaller mom and pop investors who have that hope of building up a small portfolio of 2 or 3 properties. So one primary residence and maybe 1 or 2 other.
But what does it stop them to do so? If you want to buy, let's say, investment property that costs $500,000, and your potential rental income from it is $2,500 a month, which, long story short, equals a 1-bedroom in Vancouver, right? So then, how does it prevent a mom and pop to say, okay, well, we'll just base the purchase on the potential rental income?
So the way it affects it, so technically it doesn't stop them. What it does is it makes it a lot more difficult. It's going to increase your requirement for capital. So if you have a lot of cash that you're sitting on, you're going to have to put more money down. So now you have potential, rather than you having to qualify for a mortgage on that rental property, what they might have to do, and if you have the ability to, is if your current primary residence has a lot of equity in there, you may have to look into refinancing your current property, taking the equity out, putting that as the down payment for that next rental property purchase, and then on that rental income that's going to come from there, qualify on the remaining difference. To answer your question, how difficult can it be? So at $2,500 a month, on an annual basis, that's just $30,000. So $30,000 roughly, if you take that times it by 4, based on that, you can only qualify for a $120,000 mortgage. So if you want to buy a $500,000 property, then you have to put down $380,000.
Hold on.
You could now.
I like when we get into situation case study like this, crunch numbers. You know what I mean? Put things in perspective. Hold on. Okay, so let's take those numbers again. They're pretty good, particularly for a mom and pop types of investment property. $500,000. Rental income, $2,500. So you said 30,000 yearly income times 4. Why times 4?
That's like a standard. It's an easy number for you to work with. If you take that times 4, it usually will tell you how much you're able to qualify for.
Okay.
Yeah.
So that rental times 4, 120. So basically, mortgage is going to be $420.
$120,000 is the maximum you'll be able to qualify based on that $30,000 annual rental income.
Okay.
So you as an investor will now have to come up with $380,000 as a down payment.
Oh my goodness.
So that's the issue. So now that takes out a lot of the smaller investors.
Yes, sir.
That over there lies the issue. So this will favor people who are high net individuals or people who have a lot of equity in their properties. Right? So if you have, baby boomers who are coming up for retirement, assuming they've paid off their mortgages by now and they own a primary home free and clear, they are now in a position, if they wish to, now here's the thing, we know rental income's going down.
Yes,
right?
sir.
Because of government's immigration policies. Exactly. We no longer have the demand that we've had for the past 7 years with all the international students coming in. So now, does that make sense? Like, are you going to be able to, does that make sense for you to, you're refinancing your primary residence, you're taking on more debt to get you something that gets you just $30,000? What's your return on it? Right? And so there's a bigger picture and there's a bigger discussion behind this. And, this goes in perfectly with what you and I were talking about with the pre-sale markets and the developers being in trouble. The consensus or what everybody is guessing is this is meant to reduce competition in the rental market, because what we're seeing is, pre-sale condos, they're not selling, they're sitting there. And a lot of developers have realized that. So the ones who are able to convert them into, market rental properties, rental condos, they're doing that.
Yeah.
But they have competition. Their biggest competition is the mom and pop investors. Because here in the Lower Mainland, I mean, this is not for all over Canada, but in Vancouver, in Lower Mainland, a lot of folks who have detached homes have legal basement suites. They have laneways, and those are all rented out. These developers are competing with the mom and pops. And there are many people that, we know of over the past, 20, 30 years. They have built up a portfolio. Many folks have 5, 6, 7, up to 10 properties. They're rental income producing properties.
Okay. Well, those are not affected because they already do have those investment properties.
They have it. So, but now, with the new rules over here, government is now essentially limiting the new pool of investors who would have been, because right now is the time to buy. If you have money, you can bargain.
Yeah, true. Exactly. Well, you have a point there. Like, if somebody has a income producing second property to do, like, it's a good time to do it, because they won't be subject to that new regulation. Exactly. And they can qualify for a mortgage for up to 80% of the value.
There you go.
As opposed to having to come up with numbers we just mentioned, which is 380,000. So as opposed to put like 100,000, you would have to put 380.
380, and the maximum based on $2,500 a month, you would get $120,000.
And they will still qualify. The bank will still qualify them on both their revenue and the revenue of the investment.
So from did you mean now or from January?
No, now.
Now, so now that you can use your personal income and the rental income.
Okay.
And here's the thing. So look, I've reached out, like, because this news started coming around. I'm like, that's a significant change, and it's been announced by OSFI, and we've reached out to my brokerage, asked for guidance, and they've reached out to lenders. And lenders right now, they themselves don't have any policies on how they're going to go about doing it. But we just know for a fact that this is the reality come January 2026.
Okay. Well, that's a surprise. Well, thank you for delivering the breaking news, Piyush. We should put like breaking news on
Yeah.
the screen right now.
Yeah. So, this from the way it's been put and is legislated, or presented by OSFI, it's clearly meant, the intent behind it seems like it is to bail out these developers, because it favors them, because the way those folks and developers, and then there are big corporations. We have a lot of REITs that own a lot of rental buildings downtown, like for the West End, all those towers, they're owned by corporations. The way that they qualify for income is completely different, and it's based on it's commercial lending. So it favors.
Just to explain our viewers, REITs, real estate investment.
I think it's trusts. Or no?
Trust. Yes, that's it. Real estate investment trust and developers. So the way it plays out is that those guys, they see the situation and they lobby towards the government to come up with solutions going to save them, and not necessarily you. And the reason behind this is because they lobby. Don't get me wrong, lobbying is legal. It's legal.
Yeah.
Okay. So you and I mean, on the individual level, it's challenging to lobby because it costs a lot of money.
Yeah.
Okay. Those guys, they get organized, they get together, they pitch in, they hire lobby companies. They're gonna do the job for them towards the government officials, and then an OSFI, right? Well, Piyush, thank you so much for delivering that news. You're the first person to come up with that update, and it will have an impact on market. But how is the price of those properties going to be affected?
And that's what I keep thinking about. And to be fair, like, I'm not the first person to talk about this. There have been other folks who have posted this, but with me, it's like I've tried to do my research in terms of how it's going to affect, how it's going to be implemented, and those answers we don't have yet. So that's why I waited a little bit until I got on here with you to talk about it, and it just fit perfectly with how you start off talking about the market, and that's the long-term thinking. Like it's going to, like, is it going to bring down single home family prices in Vancouver now, because now there's going to be less people who are going to be purchasing more properties? Is that going to bring down the price of condos, because there are going to be less investors who are going to be out there buying properties? I don't know that yet, because Vancouver is a very unique place, because we are limited by geography. We're not Toronto. Toronto is suburb. It's spread out. It has the room to spread out.
Let's project ourselves in February 2026.
Yeah.
I am an investor. I want to buy a investment property, 1-bedroom condo in Vancouver for $500,000. For $500,000, I go to you. You tell me no, you can't, because you have to come up now under the new rule with 380. Ultimately, I'm out. So investors are not already playing an active role in this market, and that's also explains why levels of sales volumes are so low. So ultimately, you're saying that this new rule is in favor of developers and REITs, so that they can have their units being filled up with they can have a control of the rental market, right?
I believe so.
But so now, because we have less potential buyers for that 1-bedroom condo, the price is going to go down, or are we going to see a REIT buy unit after unit? I don't think so.
So that's the part that I don't know. And then the other thing that I also thought about is, what about the people who already bought a bunch of pre-sale properties? and that's not going to be complete in the next year, 2 or 3 years, and they bought them as investment properties. What happens to them?
Well, hopefully they don't need a mortgage. And they don't need to flip it.
And it's already not an investor friendly. British Columbia is no longer a investor friendly province when it comes to real estate, because we have the foreign buyer tax, foreign buyer ban, which is also national now. Then we have the anti-flipping tax, where you can be potentially charged up to 20% in the first year and 10% in the second year if you flip a property. But I think they're probably going to have to make some sort of an adjustment. That's something we've seen this government, this Liberal government do a few times. Because remember, they had come up with that whole second set of capital gains tax.
Yes.
If you were going to be going, if your cap gain was above $250,000, they got rid of that because that was very, very unpopular. Because I see a lot of potential issues with this. There may be some ethical issues with this. I mean, if we can say that they are limiting, or they're trying to limit the mom and pop buyers. But there's the other argument that if you were buying a commercial property, or if you were buying, commercial lending works that way, where you can only qualify based on the subject property's rental income.
Mm-hmm.
Like, for example, if you were buying a commercial property and you were not being an owner, it was not going to be owner occupied like a storefront. You as Julian go and buy a storefront, and then you find a tenant and lease it out. You can only qualify based on what the potential lease is going to be.
Yeah.
However, if you go and open up your own real estate office there, you open up your own brokerage, and you're gonna have a bunch of realtors coming there, and they're earning your and paying you a brokerage fee. You're technically running a owner-occupied business. When you run an owner-occupied business, that's when you can use your income to qualify for that mortgage. So they're kind of bringing in line with commercial lending, but these are two separate things, right? So I mean, I kind of get it in terms of how they're rationalizing it, but I see a lot of potential issues with this in terms of the viability of these units if they keep building the way they're building.
Well, they are not, as mentioned at the beginning of the call. Some project just stop altogether, but they are finishing the one that started. Mm-hmm. To the extent that they can financially. So a lot of units are coming on the market. Yes, that's right. And to what extent, I mean, like, you bring a very, very interesting point. To what extent those pre-sale that will complete after January 2026, those buyers will need to qualify for the new mortgage, to the extent that it's going to become a rental investment.
Yeah, unless they come up with some sort of an extension, an exemption. Say if you bought it before such and such time, then it won't apply to you.
There is certainty that this is going to be implemented in January 1st, 2026.
Mm-hmm.
Okay.
Yeah, that part's for sure.
Okay.
So if you're a buyer on the sideline, a potential investor,
do it now. Or don't do it.
Exactly. You either pull the trigger now in the next 3 months, or you don't.
Yeah.
Like I said, this will favor the high net worth individuals, and there are many, folks who are like that. So what a high net worth individual the bank considers is somebody who has $250,000 or more in cash or near cash assets on top of the down payment.
Yeah.
When you're in that position, a bank will loan you, give you a mortgage on a one-to-one basis on that $250,000 and above. That way, you don't have to use the income to qualify. So that's potential way of qualifying. However, if you've already, and this is what my guess is, because it makes sense, if you've already used that 250 to qualify for your current mortgage, then you potentially can't use that 250 to qualify for that new rental property.
Interesting times ahead.
Uncertain times ahead.
Interesting and uncertain. That's why they're interesting, because they're uncertain. You know what I mean? If you would be certain, it would be boring. And that's why we're here, to help. And I recall in our past market update, I made a comment about delivering the information before anybody else, and I think we just did right now with your insight about this new rule regarding investment properties starting January 1st, 2026. Thank you so much, Mr. Piyush. Thank you very much. Merci beaucoup.
You're welcome.
Very good. So let's say an investor right now wants to purchase a one-bedroom condo for $500,000.
Mm-hmm.
They need 20% down, and what would be a 5-year fixed rate that they can pretend to obtain?
A 5-year fix. So usually when you're purchasing a rental condo and it's a rental, every bank will add a little bit of premium to it.
Mm-hmm.
Because higher risk. So you're in the mid 4s for rental property.
And right now prime rate is 4.7, right?
4.7.
Yeah. Okay. Very, very, very important for our viewers. Prime rate 4.7. Okay. What do you got for primary residence insured 5-year fix?
5-year fix. So what? A lot of folks are leaning towards 3-year these days.
Okay.
So with the rates, like I said, they change quite a bit, and it can be dependent on your income. So for usually the insured rate, 3 years is cheaper, funny enough, than a 5-year. You're looking at under 4% at the moment.
Okay. Which is, how would you?
It's good.
It's good.
Yeah.
Okay. So 3 years fixed under 4%.
Mm-hmm. 5-year fix, it's a little bit over. So banks are pushing for folks. They want the 3-year fix, because I think it's the they're able to forecast 3 years out a lot better than the 5-year. Obviously because of the uncertainty.
Yeah.
Because as you guys have to understand that banks themselves have cost of funds. In order for them to lend out money to you, they are purchasing funds themselves out in the open market.
Mm-hmm.
That's why that bond yield is important, because that determines what's the cost of fund for the bank.
Yeah. Very good. Well, Piyush, we'll see how it plays out for the months to come. Also, I want to remind our viewers that real estate is witnessing some seasonality. I can illustrate that through the charts a little bit, through the sales. Like if we go there, so right now we're looking at the chart from a 12 months, rolling 12 months. But if we look at it monthly, okay, we see that it goes, like peaks and valleys. And what that is the seasonality, what I call the seasonality of real estate. So every valley is January. Very simple. Okay. Why? Because December, comes end of November, December, people, they have a lot going on. They're traveling to see family. They have family traveling to see them. They don't necessarily want to have open house showings. The season is not really appropriate. It's raining, it's cold, it's dark. As simple as that. So right now, October 3rd, there's going to be another couple of weeks of active market. After that, it's going to die down. So what does that mean? It means that there might be more opportunity for buyers that want to meet a motivated seller that still have their property on the market then. So stay focused on your real estate projects, stay motivated, be clear of what are the criteria you're after in terms of location, prices, overall square footage, orientation, associated features, such as, number of parking and so on. And go out there. I think there is it's a better time to be a buyer in today's market than it was for the past 10 years. Would you agree, Piyush?
Oh yeah.
Yeah. So if you see yourself in Vancouver for the 5 to 10 to 15 years to come, and you want to invest in your property, and the property is over time going to provide you with some certainty and stability, and potentially some return on investment, it's a good time to look for property. So I don't have anything to add. Piyush, do you?
All you bargain hunters, get ready, come get pre-qualified, call Julian, let's go shopping.
Let's go. Very good. And this weekend is a sunny weekend, so I actually have a couple of tours with my buyers. But if you guys are interested, let me know, and I will do a buyer presentation to you and set up a search engine that will filter properties catered to your unique needs, delivered to your inbox, so that you don't have to scan the realtor.ca, remax.ca, and so on. Okay, very good. Well, Piyush, thank you so much. Has been very valuable. Thank you.
Thank you, Julian.
Looking forward to see you in person, and keep up the good work.
You too, man. Enjoy the weekend.
Thank you. You too. Bye bye.